Alex and Rob, go ahead and put your cameras on. Again, just a little bit of housekeeping. We will send the recording out, so you will have that, because there's going to be a lot of links here that we're talking about, a lot of different meetups that are coming up. So definitely want you guys to have the information on that front. But also, if you have questions, I'll be monitoring the webinar chat here as well as the Q&A section. So we're going to try to keep Rob and Alex from talking for an hour. It's going to be difficult, I think, at times, but I'll make sure to pop on if we're coming up on time around 2 o'clock and say, hey guys, we've got a slew of questions to get to. I want to spend a decent amount of time of that. That's the most value in my mind, is getting to interact with everybody that comes to this event. We've already got 30 people here today, so this is awesome on 1 o'clock on a Friday. So this is super exciting. Alex, take it away. Why don't you guys get your cameras on, and we are recording.
Okay, yeah, I don't think I've got an option here to do a camera on my side.
Yeah, I'm the same. I don't have a camera option afforded to me for whatever reason here.
Fantastic. Let me figure that out. Rob, why don't you go ahead and give a little background about yourself, so everybody knows who they're going to be hearing talking, and Alex, you can introduce. I'll work on the camera here, guys.
Yeah, Rob, I'll do a quick intro for you. I mean, Rob can speak for himself, but basically since 2005, Rob has been focused on delivering expertly
I think I might have messed that up, guys. Sorry. We're gonna have them join. There we go. Fantastic.
Now we're cooking. I swear I'm still not Katie Cobb, but that's okay.
That's a beautiful thing. Rob, good to see you, man.
Hey, you guys hear me?
All set, buddy. Looking great.
Okay. All right. Well, Rob, why don't you go ahead and take us away with what you've been doing in the past here, and how you've been focusing on the multifamily financial sector here.
Sure. Going back to 2015, so approaching 18-year anniversary here. I've been working in the commercial investment lending business. Started out at Washington Mutual, which for anyone who's a little bit older knows was at one time the largest savings and loan in the United States. I was there through the downturn of 08, 09, kind of saw how bad lending practices can literally cripple an institution until it doesn't exist anymore. Spent some time at JP Chase when they took over that bank, went to a small regional lender in New York, kind of during the major crises of 2009 and 2010. And then mid 2010 joined Greystone, where I've been for the past 13 years. A little bit of the difference there is working at banks, right? You're doing portfolio balance sheet lending. It's the bank's own money. They're holding the debt. At Greystone, I'm a managing director. Like I said, I've been there for just now about 13 years. And we are one of the nation's largest privately held real estate lenders for products that are investment for sale, which essentially boils down to Fannie Mae, Freddie Mac, and FHA HUD loans. We're the #1 FHA HUD lender in the United States for multifamily and healthcare, and we're a top 10 Fannie Mae and Freddie Mac lender through all of their various commercial side platforms. We are not a single family lender like some other shops maybe.
So you've been pretty dang busy over the last 6, 8, 9, 12 months with the changing interest rates and helping borrowers still get deals done. I'm sure the Federal Reserve hasn't been extremely nice to you, as it hasn't been to me and probably everybody else on this call. You want to talk at all? I want to just kind of get into it since it's on top of everybody's mind. The Federal Reserve met this week and had some things to say. And if you want to talk about where that really puts interest rates in your world from how you see it, love to get your perspective on that.
Sure. Yeah. I mean, the last year has certainly been a roller coaster. It was just about a year ago where rates really started running up for the first time in the better part of 6 years. And I think people had gotten very accustomed to when rates did go up, you kind of wait on the sidelines for 90 days and they come back down. And so we had a lot of people playing the waiting game, and they just kept losing. Rates just kept going up. There was no sign of them coming down. Then obviously with the banking crisis that started just a little over, really 2 weeks ago now, it's led to some major reversals leading up to the Fed meeting that just happened this week. Since the Fed meeting, we have seen our interest rates drop by upwards of 0.5 point. Treasury yields have stopped rising. If anything, they've actually reversed. The 0.25 point increase was expected, but I think the language about that they may be done raising rates, I think helped slow the market growth down and actually dial things back. And for us as an agency lender, because we're doing bonds for sale associated with our mortgages, the past 2 weeks has been tumultuous because as banks are struggling, right, bond buyers are afraid. They're not quite sure what the right return is for their risk. And so the spreads we were dealing with from when SVB first was announced as a failed bank, those bond buyer spreads essentially doubled overnight. And nobody really knew when they were going to come back down. And luckily with the Fed meeting, not only have treasuries fallen, but we are starting to see investor spreads on our products come in significantly as well, as there seems to be a little bit more confidence in the overall strength of the banking sector right now.
Yeah, that's what I was going to ask is, if you could talk a little bit about how, obviously the Fed says, hey, look, we're going to, our target interest rates going up, all those kind of different hot button words, but yet, the rates that buyers, multifamily buyers are able to get, the rates actually have come down. Can you talk a little bit about why that is at a high level?
Sure. Yeah. I mean, so, every institution that makes a loan is a little bit different, right? So if you're a savings bank, you have a cost of funds and you generally just set pricing at what you think is a fair level of return for the risk you're taking with your depositor money. Our products are more transactional in the sense that it's a little bit more like buying a stock, right? What the world thinks it's worth is what it's worth at that given moment. And that can be good for you or bad for you as someone who's taking a loan. And so for us, the potential inflow of business since the original announcement of SVB failing and banks around the country really having to tighten up their liquidity has been a major boon for us in terms of opportunity. We're seeing all sorts of new customers, people who didn't like our products for various reasons in the past. Maybe someone who is just, well, Rob, you're a great guy, but I've been a choice client at ABC Bank and they kind of give me whatever I want. There's no one getting what they want from banks right now. Banks are in a very difficult position where they desperately need cash. And so to do cash out refinances, to make new mortgages on purchases, right, that's going in the wrong direction. And for the most part, they can't demand large level deposits from their borrowers. You can from obviously the upper echelon folks who have a ton of liquidity, but the general, everyday investor, they don't have millions of dollars in cash to move around from bank to bank to secure a loan. It's something that was quite common back in the 2010 era, where it was, if you want a mortgage from bank C, you have to probably deposit a minimum amount of money with them. That concept is, we're hearing that more and more as well. They'll give me a loan, but they want me to move all my money there. And the problem is you probably have other loans that are under the same condition with another bank, right? And so it's robbing Peter to pay Paul. And so within that, agency loans, very popular right now because we have no banking restrictions at all. You can bank anywhere you want. We don't want your money. We are not a bank. We can't hold it for you. We are purely there to make a real estate loan. And so our ability to not worry about that side of things has been tremendous. Additionally, again, because banks are so cash, they're in need of so much cash, they're very willing to, we're seeing waive existing prepays actually to try to not grow the book, but shrink their book of existing business, right? Because if you can't take in deposits, one thing you can do is shed liabilities. And so if they can get loans to pay off, that's essentially doing the same thing for their bottom line. And so not just from borrowers, we're actually having bankers call us, from institutions I won't name, saying, hey, we're going to send you 30 or 40 deals to take a look at. And if you can take any of these off our books, we will happily waive any sort of fees the customer would experience on the way out as they try to stabilize themselves.
What kind of size banks would you say that is? I mean, is that like your local mom and pop banks around town, or is that more the medium regional size, or what are you thinking there?
Right now, it's all across the board, but I think the banks that are having the most trouble are the medium regional, partially because, and without getting too deep into the economics of what's going on right now, right? But the reality is this concept of a run on a bank is just people get scared and they want their money, right? They don't want to leave their deposits there. The truth is, the only reason SVB got in trouble, right, is they mark their bonds to market for sale, and the value of those bonds, if they had to sell them early to generate cash, is well below what they paid for them, right? And so it's a massive loss. People hear that, oh my goodness, they have this big asset that's not worth anything. We want to get our money out of that bank. The truth is, if no one took their money out of the bank, they don't have to sell the bonds. It's kind of a one after, right? People started pulling money, which led to the sale of the lost assets, which led to more people pulling their money, which led to the bank's collapse. So the really small local banks who don't mark anything for sale, that data is not really out there. They can just say, we're just going to ride this out and not worry about it. It's more that mid-sized bank that maybe had aspirations of growing to the next level. And so they started doing some of those capital markets and treasuries activities that would involve kind of publicly stating, what you have on your books. And that gets you, especially now, right, the regulators are looking at everyone. And so it gets your name in an article that you might be operating just fine, but you cannot afford to have your top, let's say, 100 depositors show up and want to move their money to, a Bank of America, a Wells Fargo, a Chase, which I think are probably the three of the institutions that are now deemed, too big to fail, right, by the mainstream populace.
Okay. And can you talk a little bit about, I want to go back to, a few years ago, I don't know if anybody remembers, there was a pandemic that happened in 2020. But in that time, we've got lending then, right, which is basically free money, but was still kind of hard to do deals. And then now you've got time, which is more expensive money, and it's hard to do deals. Can you talk about how the pandemic really kind of, that lending market differs compared to now in terms of the ability to get deals closed?
Sure. I will caveat that this is my personal opinion, and I don't necessarily know if Greystone's economists would agree.
Sure.
I think the pandemic, the timing of it, stalled what was about to be a market correction. I think the real estate market and many other markets were very, very hot. They were probably ready for rates to start rising, cap rates to start going up, values to start coming down. And instead of that happening in the course of natural business, which it does, these are cycles, the pandemic happened, and all of these ancillary things led to all of this free money and all of this monetary policy that not only stopped rates from going up, it actually dropped them in an entirely another layer of low, right? We got to a whole new level of what low could be. And it's almost like pouring gasoline on a fire, right? It's like, oh, we think that little fire over there might go out or start to diminish, and someone throws a gas bomb on it, and now the market is just crazy. And what happened is a lot of people it was easy to borrow a lot of money very cheap, and it pushed pricing higher and higher and higher. And it's the age-old thing, right? So now we're at a period where now money's more expensive. And so we have sellers who are looking back maybe a year or two ago going, well, I didn't sell, but I still want that cap rate, right? I think I could still get that price. And buyers might even think that price is reasonable, but the money is so much more expensive. The leveraging doesn't work. Debt funds are not out there aggressively making loans. We're seeing, the syndicator model, they're struggling to raise equity from folks like they did 3 to 4 years ago. And so I think it's a little bit of a perfect storm. There's a lot of things going on at once that is slowing down the market. And what's fascinating is real estate itself, if you take out debt and equity needs, the underlying real estate is operating beautifully across the country. Vacancy is incredibly low. Rents are still growing. The need for rental apartments has never been higher, and it's expected to continue to grow. And so it's a very odd time. Usually when these things happen, it's also kind of in conjunction with a general weakening of the market fundamentals to the asset class itself, right? I think similar things are being said in the industrial sector, right? There's no industrial to buy, but everybody wants it. And so it's fascinating. This is a different type of market turn than we've seen, going back 15 years.
Yeah, I'm glad you brought that up, because I wanted to ask you, since you've been through the 2008 crash, some of us have been in different industries, many of us haven't been. I just want to get your opinion. It's not, a Greystone opinion necessarily, but your opinion. Maybe it is a Greystone opinion, but compared to the feeling that we have now, right? I mean, at least a week ago, there was, some panic that people were having about sky falling. There's buyers all over the place. They're salivating. They can't wait for the bottom to drop on just different thing because they smell opportunity. But can you compare the feeling that's kind of been going around the last several weeks now compared to maybe where it was in and around 2008, if you're able?
Absolutely. It's a very different time. In 2008 and 2009, the sky started falling and unilaterally everybody ran. Rich, 30-year veteran of the industry, a guy who's been doing it for a year, a family office who invests all their own money, a syndicator who has nothing in the deal themselves and is, relying on investors. Back then, the whole economy was falling apart. And so it was grab your cash, stuff it in a mattress and hope we come out. This is very different. We are seeing the strong cash flow borrowers, guys who have a lot of liquidity. The constant call is, what are you hearing? What do you got? Who's in trouble? What can I pick up cheap? There's incredible faith in the assets. They are looking for deals. Now, deals are a very different thing now because cap rates have been at historic lows for many years, right? That was also not a factor in 08, 09. Values were high, but they were not nearly as high as they've climbed in the current climate. A little bit because debt wasn't as cheap back then. And so it kind of calibrated a little bit better. And so I think this will be a shorter cycle because of that, because I think there are a lot of folks who want to step in and fix the crises and then kind of step in and say, oh, I'll pick up your mess as long as I can get it at a discount. And so I think that will correct us faster. I think the challenge now is just people deciding when is it time to maybe throw in the towel on something that's not working. When do banks start actually looking to offload assets that maybe they're not going to be able to get refinanced out of, right? Do they start doing loan sales? We haven't really heard a ton of that yet, especially in the multifamily space. A little more prevalent, retail, office, hospitality, just because those have been so impacted by COVID as much as anything. And so it's a little bit of a waiting game. I think there's a little bit of chicken going on. Lenders are just like, yeah, we know you want it. Right, the lender has to take the loss. So the existing owner has to take the loss, and I don't think anybody's quite at the position yet to agree that it's time to start doing that. And on the other side, right, if you're someone who's well capitalized and you don't have to be constantly buying, you can just say, "That's great. I'm going to wait here until it is time." And so I think that's creating quite a log jam in the market. We're seeing a lot of buyers and a lot of sellers struggling to find a common ground as to what something should be trading for today.
Yeah, no, I mean, we see that all the time, right? I mean, I'm sure Logan's has experienced it. Our buyers and sellers have experienced it. Everybody wants, the common comment is everybody wants, the buyers want, tomorrow's prices of, the sky is falling. Sellers want yesterday's prices when cap rates were 3-4%. And it creates some challenges in getting deals done, especially I'm assuming with the institutional type of lenders, and people that are buying property in that kind of space. What would you say is a good explanation of the role of interest rates here in the multifamily industry?
Sure. I think the incredibly low rates of the last few years, right, really elevated the concept of value add, right, to just about every sales pitch for a sale broker. And if you're someone who's raising equity to go buy a property with investors, right, just about every purchase of the last handful of years has been a value add proposition. Those are great transactions. They're very successful. They also tend to be very easy to pencil on the front end of a deal when your bridge money is 2.5%. right? When interest rates are so low that the money's nearly free, the model works very well. That's great for those guys who buy buildings at a price they're comfortable with. They execute their plan, they raise rents, maybe they, change the class of a building from a, B+ to an A. They, maybe do some rubs and they get out utilities, they get all these benefits. The challenge becomes is every one of those transactions is pushing the in-place cap rate for the market lower and lower and lower, right? And so the normal customer who maybe doesn't have as much upside, all they're seeing is, oh, this sold at a 4 cap. And then they want a 4 cap. And then, right. And so it's this kind of, growth system where those low rates pushed value to a level that was probably never sustainable, purely just based on the amount of equity you therefore would need to close. And we're now seeing that same issue where we're seeing wonderful deals come across our desks at per unit bases, prices that make a ton of sense. And that I would say, yeah, that's a great buy for that market. And then we have to layer the bad news, but that you're going to have to put 40% of the equity in purchase because it doesn't cash flow.
Right.
You take that with higher rates, taxes are up pretty much everywhere. Insurance is getting more expensive by the day. It's a challenging time. It's a challenging time for the space. And yet I fall back on people need housing, rents are growing. It's a fascinating time to kind of be involved.
Yeah, I wanted to piggyback onto that because, we talk a lot about different type of lenders and, you're with Greystone, you guys do, big deals, medium-sized deals. If you want to talk a little bit about what's a good, price point and style of property, not the best, not the ideal, because everybody's got their ideal opinion, but what's a good project, a good deal to bring in front of your desk to evaluate that you're confident you can get funded?
Sure. So from a range perspective, right, we'll go down and do a loan as small as $1 million. That's kind of our floor. There is nothing too big. I think to date, the largest Greystone single transaction is a little over 550 million. On a single project. So obviously
I'll be doing that soon. Yeah.
I know we've been talking about that.
Yeah.
Look forward to it. It's a big rent roll though. But no, it's funny as a firm, I think our sweet spot, my sweet spot has been in the Freddie Mac SBL space, which has been a very hot product the last handful of years because it kind of combines an aggressive agency underwriting and non-recourse debt with terms in terms of fixed term prepay structure, those kind of things that are a little more common in the bank world. So it helped, I think, bring a new layer of small to mid-size owner into the agency world where before maybe they felt intimidated, thinking the product was just for only, like you said, $25, $50 million deals. Truly not the case at all. I'd say as a firm, our average deal size is under 10 million. Mine personally, I tend to be like an aggregator of a lot of deals here. So my average is probably closer to 3 to 4 million. I think the bigger key for us beyond size, right, is what are you trying to finance? If you have a stabilized asset, right, you've got your rents, you've got your expenses, the building's well occupied, you've got good payers, you're not looking to, finance today and then refinance 9 months later after you've done more work. We're looking for stable assets, right? We are, our primary products are going to be what is the deal cash flowing for today and what can we base on that loan? So folks who come in with, oh, I'm buying and it's 80% vacant, or, I want a 2-year loan so I can, do a ton of work to it and flip it. We have ways to execute those, but those are not our bread and butter. Our bread and butter is really going to be, hey, we've kind of completed that business plan, right? And now we're looking for that permanent non-recourse financing that can kind of make this a little bit more coupon clipping for us and move on to the next, real project.
And as far as that goes, I mean, are you guys willing to do deals in the, BCD kind of locations, BCD class of properties, or what's your sweet spot there?
We absolutely are. So one of the nice things about working with federal government loans is, they can't deny any location outright. Now, there may be leveraging limitations, right, based on the size, strength, crime history of a market, those kind of things. But generally, we can work with folks in any market. It just might not be to the level that someone wants, right? And so, yeah, we can do all those. Obviously, if a building is not being maintained, that's a very different thing than the location of it, right? We can't redline because of the street you're on, the city you're in. That will never happen. But if you're a landlord who's not keeping his asset up and we don't feel it's safe, that we can turn you away and say, sorry, you're not for us. We're not for you.
Yeah, no, I think that makes sense. And I'm assuming then, what are you guys able to leverage 80% on any deals, or is that pretty dang unique? Or 75%? Where are you guys coming in at the leverage right now?
It's interesting. So when rates were at that 3% range, we were hitting 80% quite frequently. Cap rates had still been probably in the fives, trending downward at that stage, and we were able to max out leveraging. When rates start running up, right, our debt service coverages become significantly more relevant to the discussion. And those tend to be our limiting factors. And so what I generally tell people is, especially in the current environment, they go, what's your LTV? Said, you don't worry about it. You're not going to hit it. You're not going to get there. Unless you've got the buy of the century, we're probably not going to find max LTV, but it's really about who's underwriting cash flow the most aggressively, right? That's going to, in theory, lead to the highest LTV deal. And so that should be the bigger conversation for us. In general, we are 125 debt service lenders at the note rate that we're offering you. We do have some products that go actually lower than 125, down into the 120, and even we can sometimes get down to 110, depending upon the specifics of what we're talking about.
And what are obviously yesterday's announcement, but then the craziness of the rates. I was actually just looking right now. We've got the 5-year treasury at 3.4, the 10s at 3.37. So, what are rates that you're quoting kind of at this time?
Sure. We rate locked a few deals yesterday, so I've got some pretty good data. A $5 million loan in Denver, Colorado traded, just looking here, 5.28%. That was a 10-year fixed rate loan with a 35-year amortization schedule to try to help push some dollars. We locked a full term interest only 10-year loan at 5.5% later in the afternoon. So rates for the most part are floating to about 200 basis points over treasuries in total, which those spreads are a little wider than they were maybe 3 months ago, but net, the rates are much lower just because of where treasuries have come back to after kind of that constant climb upward that had been going on. Okay.
And what are you guys anticipating here over the next, couple months, typical deals? Actually, that's actually brings up a good point. How long is a typical, somebody brings you a great deal that either they're, in my world anyway, it's usually they're trying to buy, but a lot of people on here probably look at refinancing or will have to refinance some deals at some point soon. And so how long does that take when working with a Greystone to start to finish? You got the deal, you got it, started, you guys are probably going to do the lending. How long does that take?
Sure. Varies a little bit by program type, right? What we're shooting for, but I would say the average Fannie Mae loan closes in less than 60 days. A Freddie Mac loan is probably a little bit closer to 90. Interestingly enough, where we're struggling right now is vendors. Appraisers and engineers are really stressed to the max with volume. And so those reports that we need, right, to really do the critical work of setting up a loan are taking longer than they usually would, which have pushed those windows out to that 60, 90 day level. With that being said, we've closed deals as fast as 3 weeks when we need to.
Wow. Okay. So you can do it pretty quick if you absolutely need to, foot to the fire, and the deal looks amazing.
Correct. There's ways to speed things up. It just has to be understood that, if we can't find an appraiser that can't get us a report in less than 4 weeks, I can't close a loan in 3 weeks. That just doesn't work. And so, we're constantly trying to juggle what's going on in the market and be honest with folks on the front end about the reasonableness of time, especially in a sale transaction. We want to make sure both sides understand that, I think sometimes there's this concept that if it takes more than a month, it's a bad sale from the lender side. And it's really just, if all parties are working together and we can kind of, be in touch with the seller side and be like, hey, there's nothing bad going on here. You know, this is just the normal process. I think it helps everyone get to the table comfortably.
Sure.
It takes a couple weeks longer than they may have thought.
Yeah, I just got one more kind of main overall question here, and then I think we've got several questions coming in via the chat that we'll have Katie kind of queue up for you. But, you know, what are the real opportunities? I mean, obviously there's a lot of challenges right now in multifamily, at least compared to where we were a year and a half ago. But what are the opportunities that you're seeing or hearing that are out there for, you know, an active investor that wants to do deals and maybe even needs to do deals?
Sure. It's been very interesting. I track this very closely. I'm fascinated kind of by the micro and the macro of the industry, right? And the nice thing about a Greystone is I'm a national player, so I'm not limited to my general vicinity here in Kansas City, right? Where I kind of just have to focus on my market. You know, I'm truly doing deals from coast to coast. Right before this, I was on a call with one of my clients who were doing a deal in Los Angeles. And my biggest market of activity is probably New York City and secondarily Miami, right? So those are kind of a nice big triangle covering the whole country. Where we are noticing sales are happening tend to be in states, or maybe I should say this, where sales are happening where I think the buyer is getting a really good opportunity. They tend to be Democratic states where there is major concern about rent control potentially being installed or ramped up even further than it may already exist, and or the concept that taxes are just going to keep growing faster than the market can keep up with rents. And so markets like New York City, we're seeing where you have rent stabilized assets, right, that make up a large portion. We are seeing a lot of long-term owners just saying, I am done with this. I can't play this game anymore. They're trying to socialize housing, and you know, it's not a business. It's as if I'm a charity. And so if you are on the other side of that saying, hey, I'm willing to take that risk, thinking that maybe this is a wave and it's going to then go back to being more advantageous, right? You can pick things up for some great prices and compared to where they may have been trading 5 to 10 years ago. And so,
okay, so you've got a lot of sellers, or I don't want to put words in your mouth, but you've got several types of sellers that are tired of the, you know, politics of the state and maybe seeing something on the horizon or fearing something on the horizon. So they're like, hey, look, I'm done with this area. And, you know, on our side here in Kansas City, you know, we see that with that money coming into our market, right? Where they've got, you know, a lot of money that they're doing a 1031 exchange in the Kansas City market for whatever asset class and type and size they want, oftentimes multifamily in this kind of, you know, no rent control zone and low taxes and landlord friendly kind of place. But yet you're still seeing obviously buyers come into those markets that you're talking about, New York, Miami, Los Angeles, that see it as an opportunity to buy something that's already stabilized and maybe a decent for that market cap rate.
exactly. And on the flip side of that, I think what we're seeing people really trying to do is uncover the gems that may still exist in those other states, where they're very confident, maybe based on a strong Republican nature, that there's not going to be increase in taxes and that there will never be implemented rent restrictions, right? And so we're seeing investors from, you know, traditional Northeast investors, let's say, or traditional California investors looking for new markets, looking for places where they think they can take that entrepreneurial spirit that really is what makes commercial real estate what it is, right? And kind of turn it into, hey, if I put in the work and execute a plan, I want to be rewarded to the fullest, not with a, you know, kind of restrictor plate on me based on what the local township or city or state may say I'm allowed to do.
Yeah, makes a lot of sense. Okay, I think we've got some questions coming in. Katie, I don't know if you have the ability to ask those here.
Yes, I can see them up on my screen. I will just go down the list here. The first question, Rob, is it's an anonymous question, but it says, what is the typical LTV you're seeing right now for most multifamily deals? Are you seeing any deals good enough to hit 80%?
I'd say our average transaction is probably around 70% right now, based on the fact that we still haven't really seen cap rates start to move up very much, even though rates have started to rise. And so we're still seeing values, even on refinances, stay quite high. We're not seeing a ton of sales where the prices have really fallen yet. We are expecting that to start to change, and we are hearing or kind of getting previews of deals where it's like, oh, we could get much closer to 80 than we probably could have on that same property 6 months ago. So I think it's coming. We're just not seeing it quite as frequently, although, you know, like I said, there's always someone who uncovers that diamond of just a beautiful deal, and someone maybe doesn't know what they have, or, you know, it's an estate and they're not sure, someone who just thinks they might be smarter than they are, and you know. So yeah, we are doing 80%, but it's not the common at this stage.
The next question comes from Jason. He asked, when are sellers going to be more realistic? It's very hard to make $5,000 average operating expense, $900 to $1,000 rent projections, $8,000 to $15,000 in interior updates, 6 to 7% cap, 6 to 7.7 interest rates, and still pay $80,000 to $100,000 per door doesn't work. How are you making these deals pencil when you underwrite?
It's a great question, and it's a very good point. I think what that person probably should realize is that same person who he's trying to buy that building from is very unlikely to be in the market trying to finance it at the exact same time. They already own it, and they probably financed it when rates were much, much lower, making all of this very simple. And the reason I bring that up is because it's going to lead to the answer, which is when all of this is going to change is when all of that really cheap debt starts maturing, which is going to happen over the next 2 to 3 years. As loans start coming due, many owners are going to find themselves unable to pay off their existing balances, not due to poor operations or any misdoings on their part, purely just if rates stay too high, they did not increase their income enough to support the dollars they previously borrowed. Once those maturities start coming up, people are left with a choice. You sell or you default, generally. What I always tell people is if you can sell and get out for even money, you live to fight another day. You can do another loan. The minute you start handing keys back to lenders, you become an ineligible borrower for just about every other lender in the market, which means you're not just handing keys back on that one building, you're basically admitting that you're exiting the space. And so with that, I think as we approach the summertime here and keep going further into 2023, 24, more and more borrowers are going to find themselves at that crossroads of, I cannot refinance, I have to sell. And that is when pricing is going to start dropping back down to where for a new buyer, right, there's an opportunity to lever their money into something they see as a worthy return.
Perfect. Okay. And the next question is from Andrew. He said, speaking of a price correction, to what level, if any, are you seeing deals get discounted by sellers to move property, both new and vintage product? It's a two-part question. The rest of that is, and if so, can you give a general idea of how the cap rates have moved relative to those discounted sales?
Sure. I think if you're talking Class A, especially institutional size Class A, we have not seen any movement. Those transactions slow down and they're not trading as fast, but those tend to be very deep pocketed groups and they will wait this out. They know that this is not the next 10 years of interest rates, most likely. So they can carry their deals. They tend to have very strong lender relationships where they can make things last. I think it's really the older vintage projects that we're seeing the challenges on, where someone, especially if you bought the building just in the last few years, with visions of massively higher income and a price that's going to grow by 50%, we are starting to see a lot of people who picked buildings up in 2019, 2020, without having executed their business plan, putting them back on the market to see if they can get out of them just for what they owe. They probably have floating rate bridge debt. That money is wildly expensive. And because every lender is being stressed by the banking crisis, there is a very, very heavy eye on what's going on. And so they're being asked for a lot of financials. They're being constantly kind of called into question as to how operations are going. And so as with that going on, I think those older vintage properties across the country, we're seeing kind of some raising cap rates, and folks who are like, well, I want 25 million. Well, we have someone who'll give you 21, and they go, yeah, I'll take it. And we know that means they're not into it for more than 20, right? And they'll take their money and live to fight again. And I think that will continue to struggle as well as we go forward, and more of these deals reach a maturity point on that debt where it's no longer do I want to sell, it's I have to, or you have to go back to your investors and do a capital call, which, I mean, FTW, and you guys can say better than anyone, not something you ever want to have to do to investors. So, you look for the alternate option, whether it be some other type of alternate financing, or maybe you dispose of the property earlier than anticipated and get everyone their money back, with maybe a little bit of a less return, but a return nonetheless.
Just to piggyback on that, here in Kansas City, are you seeing people, because of some of the things we talked about earlier, right, where it's a good landlord state, it's friendly, low taxes, et cetera. Of course, everybody loved the days when we were at 80% LTV, et cetera. And now you talked about maybe 70% or whatever is kind of average. Do you see a lot of these, especially in your range, right? You talked maybe $3, $4, $5 million bucks. People is like, you know what? Yeah, 40%. If I got to bring 40% down or 35% down, that's better than leaving it in the stock market. Or is there any of that kind of mentality, or what do you hear people say when they do have to bring more money down to the table?
It's fascinating. I think if you're a local Kansas City investor, right, and this has been your market for, let's say, your career, right, you've been here for 10 or 20 years buying buildings. I think those people are kind of waiting things out more than when it's like, when we deliver that, we can only leverage you to 60%. And they're like, well, okay, it's 100,000 a door. My general follow-up question is, are you from California or New York? Right? Because it's the cost basis is what's really attracting them, right? They're able to pick up a large number of units at what they deem to be a reasonable price compared to what they're seeing on the coasts, right? I say, rent stabilization in New York is brutal. Well, units with zero rental upside in the Bronx still trade for $175,000 a door. So it's relative, where, in Kansas City, that's a very, expensive unit for many buildings, free market, nice quality, not 100-year-old vintage. And so I think we're seeing more of a nationwide play here go on, where people who are going to buy in these environments with more equity down are likely to be absentee owners who probably aren't from the Midwest states, where they're more used to kind of a stable pricing scenario. I think those folks are waiting. And I think it's really being driven by the coasts that are kind of picking up the product that still remains at the kind of the current environment.
Yeah, speaking of the coast and those different markets, I mean, Kansas City, of course, this is Kansas City multifamily meetup groups. That's what we're all about here. But, I think we're all always curious, what other markets people, you're hearing and doing deals in that are similar to Kansas City. Of course, we hear about Indianapolis. We hear about, I don't know, Omaha, Des Moines. I don't know how similar those are, but if you have a feeling or an insight into kind of what activity you're hearing about, like maybe someone says, I can't do a deal in Kansas City anymore, so I'm doing a deal in X, Y, and Z area.
Yeah, I think you actually said two that I would have picked is Des Moines and Omaha. We're kind of seeing the range, right? Maybe that local Kansas City investor who never left this pocket, they're comfortable reaching out because they feel like they've got enough market knowledge. Des Moines, specifically Davenport, we've seen some great deals go down in some of these slightly less known areas, different parts of Missouri. It's becoming less regional and more national for many owners, right? The idea, I think the concept of third-party local management, people are much more comfortable with that now than they were maybe 10 years ago. I think the old adage used to be like, if I'm going to own it, I need to run it, and therefore I need to be there. I think a lot of that is going away, and they're realizing that, with the availability of technology and the ease of travel, that you can pick as long as you pick the right third-party partner to run your assets, boots on the ground, your investment footprint can grow massively in terms of your range. And with that, kind of puts us everywhere. We still see fascinating deals in markets all over, where I'm just amazed by the price, either high or low. We just looked at a deal in Jacksonville, Florida today that was $88,000 a door that, I would have bought right on the spot. I would have said, absolutely, let's take it. A great buy. And it's still probably only levered to like 65% of what was being asked, but the basis was perfect. And so it's really deal by deal. And with that same saying, I'm sure by the end of next week, I'll see another deal in Jacksonville that's like 3 times the per door cost that someone's, trying to move. So there's a lot going on right now. And like you said, the sellers are still thinking to yesterday, the buyers are looking to tomorrow. And we're all kind of actively waiting for those two groups to agree that it's time to really just start transacting again at a more frequent level.
For sure. Katie, do we have some other questions that have?
I got one. I got one question. I've got to ask.
Oh, yeah.
So, Rob, my good friend, I need to know where interest rates are going to be in 2024 and in 2025 from your perspective.
Sure. Let me just finish a bond purchase here really quick. I'll buy some treasury now. The caveat being every customer I think I've ever talked to says to me, where are rates going? And I have to remind them that if I had any clue where rates were going, I wouldn't be doing any of this because I'd be retired on the beach with billions and billions of dollars. With that being said, I really believe with a presidential cycle coming up that there's going to be incredible pressure from both sides to keep rates in the general range that they currently are, barring any major continued market disruption, right? If we have another 10 banks that suddenly are illiquid, all bets are off, right? The economy is going to see a major, major downturn. But assuming we stay where we are today, I think we're going to see US Treasuries hold pretty consistently. I think it'll probably take 6 months for a lot of lenders to feel safe to really get back into the market. So those interest rates will probably hold to that, where they are today, which, for us, like I said, is in the, let's call it 5.5% range, kind of is a safe number. I think spreads will start to drop again as we get to the later parts of this year and into 2024. And so I do think a lot of these folks who are feeling the pain right now, I think there's relief on the horizon, but honestly, it may be a year away before they really see numbers that, make them feel comfortable. With that said, I don't think we're going back to 3% mortgage rates. And I think people need to really understand that that was not normal. It was an anomaly that went on for way too long. It's what got us into this position today in the first place. It's the number one reason why all of this is happening. And so with that being said, it's, don't scoff at a 5% interest rate for 10-year money. I know newer investors think that sounds like it's crazy high. That's relatively common rate for the history of US lending.
Yeah, I totally agree with that. I mean, we've looked at all the charts over history of time. Now, of course, the flip side is, cap rates were obviously, higher, much higher, but I mean, there's all these other new factors that go into why things are the way they are right now. But I wanted to get back into like the microeconomics of it a little bit, on a deal by deal basis. What's the number one or two or three things that kill a deal, either as it's being in process through your, your lending platform? And the reason why I'm asking is because I'm trying to help all of us investors here make sure that we have our ducks in a row before we go to a lender like yourself to make sure it has the best chance for success.
Sure. There's a couple that stand out. And these are so common that they're right at the tip of my tongue. So the first one is understanding how real estate taxes work in the market that you're buying a building in. The number of folks who send us deals and they go, hey, here's the seller's numbers and here's my pro forma. And I can say almost exclusively the tax number that's on the historicals is going to match the pro forma. And they don't recognize that, let's say they're in a state where the sale is immediately going to trigger a reassessment, which is immediately going to trigger a new tax number, right? So Florida is a perfect example of this. Every transaction leads to a reassessment of taxes. I'm blown away by the number of people who will put down hundreds of thousands of dollars on contract deposits without a clue that that is how the state works. Do your research, understand your taxes. Number two, if you are in a state that has issues with earthquakes, flooding, hurricanes, tornadoes, be cognizant of the fact that insurance is essentially an upward climb cost all the time. No one's like, oh, hey, insurance rates have come back down in any form of insurance anywhere, and nor are they going to in real estate. And so be just aware if you're buying a building on the coast somewhere, you're going to need some really expensive storm coverage. If your building was heavily flooded during a prior storm, check a FEMA flood map to see if you're going to need flood insurance if that lender requires, right, to have excess flood coverage. These are all things that can blow up a deal that me as a lender, I don't necessarily have all that access at my fingertips on day one, right, to advise. We do our best, but you know, we're also responsible for every city in the entire United States theoretically can cross my desk. We can only know so much.
Yeah.
Those are big picture things. Macro concepts to be focused on is number one, aged receivables and who is and who isn't paying rent these days. Because the CARES Act is still out there, because evictions in certain states are still challenging. You know, it used to be, is the building occupied? That's what we looked at. How many tenants are there? Now the question isn't as much as how many are there, how many are paying, right? And we still see markets across the country where, yeah, it's 100% occupied, but 80% of them are paying. That's more expensive than having a building that's 20% vacant, right? Because you have 20% of people who are living for free. You're paying their, you know, utilities, they're damaging the units, but they're not paying you rent. And so to be aware, make sure you're paying attention to what you're buying. You know, are the people in place paying rent? And if they're not, what's the plan? Is it a place where you can easily evict them after closing, right? Or is it like, wait, this person's not paying, and due to the various, you know, government subsidies still being offered to folks, am I inheriting someone else's problem, right? Am I going to be battling this person for a year or two with no rent? Those are probably the biggest items that have just kind of been sideswiping deals for us over the last 6 to 12 months.
Okay. John Wires, are you still there? Are you still on? I wanted to bring you into this if you're still there, because, you know, this KC multifamily meetup group is here. You know, we had John help us get, you know, a lot of this going together. You know, quick, you know, side story here. We've got the multifamily meetup group. We're going to meet again at the end of April. So pay attention to your email there. But I wanted to bring John in to see if he's got any other specific questions here for Rob related to the industry. And then also, before we run out of time, I want to make sure that everybody gets Rob's where they can contact him at, his social media accounts, his email, whatever Rob wants to share. But first of all, John, if you've got any questions for Rob, go ahead and hop in.
Can you hear me okay?
Yes,
Yeah,
sir.
Good. Oh, sorry. No, I think everyone covered it pretty well. It was pretty extensive interview, so appreciate you guys going through that. That was really in-depth explanation, and we definitely need someone like Rob navigating us through this market, especially nowadays. But yeah, excited to you know, combine efforts and get people started again on a consistent multifamily group. So thanks to Alex and Logan and Katie for helping structure and putting this together. So looking forward to it.
Us as well. Okay, Rob, how can people get a hold of you?
Katie just was kind enough to throw all my contact info in the chat, so it's right over there, but it's robert.meehan@graycode.com. My phone numbers are there. And I would say to anybody who's, you know, feel free to reach out to chat about deals, just the markets. You know, my business practice has been built on referrals as well. I'm a big fan of, if I'm not your place to be, if I can't do your deal, my goal is to try to put you in touch with one of my fellow bankers in the industry, whether it be here in Kansas City or around the country, to help out. I believe, you know, that kind of goodwill just leads to future opportunities for everybody. And so, you know, don't ever hesitate to reach out and pick my brain or just chat about a possibility.
Awesome, Rob. Well, I really appreciate your time. Everything you've said here has been very insightful for me. I think a lot of the other attendees here have found great value in that. I mean, as I mentioned, we're having another multifamily meetup group coming soon here, end of April. It'll actually be in person. So if you're in town, want to fly to town, want to do whatever, TBD on the exact location, we'll know that soon. But we're pretty intent on the end of April. It's going to be a 2:30 start time on Friday. Katie, what's the date on that? I forgot to put that in front of me here.
I believe we are doing, again, it's Friday the 28th is what we had said, Friday the 28th of April. It's the
Awesome.
last Friday in April.
Great. So yeah, we'll be able to get everybody there together in person, you know, networking. keep this baby going. I mean, we just want to be a connection group. This has nothing to do with Exchange Commercial Real Estate or FTW Investments. As far as, I mean, I don't want to speak for Logan there, but this is just kind of getting people together. I don't know how many times, probably John has had it as well. John Wires and myself and everybody in this group, we hear all the time, hey, where can I connect with multifamily investors? Where can I meet other investors, other brokers, other agents, people that want to do multifamily deals, in this 4, 6, 8, 12, 100 unit space. And so our goal is to just connect people, get deals done, bring in value, like someone like Rob that's going to help out and really understand the lending market, specifically in Kansas City, just somebody we can ask right off the top of the head here and keep this going. We also have two coming up, and Katie can talk about the details, but because I'm not going to be there, but it's opening day Royals here coming up the 30th, which is next Thursday. We're going to have a whole bunch of stuff going on. So Katie, you want to fill people in on what's going on there?
Yes, Royals opening day. To opening day. If you guys are coming out to the game or just want to come out and tailgate, you're welcome to join us. We'll be out there from 12 to 3. I'll drop my email in the chat over here too, so I can send you additional information on where we'll be. Anyone's welcome to come, have a hot dog, grab a drink before going into the game, or just come hang out with everybody.
Awesome. Will anybody have anything else? Logan, you got anything else? Rob, Katie? Yeah, go ahead.
I think we actually do have just a couple more questions before we end, if we can throw those in.
Awesome. Yeah.
Sure.
It looks like there's 2 questions about senior housing. So I'll try and combine these right here. It looks like Aaron wanted to know if Rob, if you see a bigger appetite for other asset types such as senior living. And somebody else asked another question too about will there be many people investing in senior living or senior housing arena with people wanting multifamily? So where you see senior housing going?
I mean, listen, we're an aging population of people who are living much longer. So senior housing is going to continue to grow in need. And as such, the space has grown tremendously over the past decade. Obviously, the pandemic had a significant impact on that, whether it be politically or just kind of news purview, right? You have a building full of more elderly folks. Unfortunately, we know how COVID impacted some of those, and it negatively kind of put maybe a tinge on the space. One thing that people should really keep in mind, though, if you're not someone who's in the senior space and you're thinking about it, is if you are going to operate a facility that is cash pay only, that is fine. But if you are going to accept Medicaid, for example, you get caught in the political crossfire of how the government feels Medicaid should pay. And your rates for your people in your building can swing dramatically year over year. And so you have to be very well capitalized and have significant financial cushion to keep operations, because you also can go to jail far more easily for not properly managing a seniors facility than you can just a regular old apartment building. The general public has a real soft spot for grandmas and grandpas, and nobody wants to hear that they're being treated poorly. And so you need to, the costs are very, very high. And so we've seen a lot of people who've made what we thought were very good investments into senior space. And then as the government rates for reimbursement for those services drop, it becomes very hard to break even, because you legitimately in that space, you can't cut back on services. You can't just not have nurses and, orderlies and things like that. These are things that these people must have to survive. And so it can be, I think it's a booming space, but it is one that is harder to succeed in and harder to run than just a traditional multifamily. And as long as you go in eyes open, you can succeed, but it's not one and the same.
Those are some good points. Can't just leave them out there. Let's see, there is a couple more questions. What kind of financing can we get on BTR community?
Yeah, so it's fascinating that we talk about build to rent. It's certainly a huge new space that's really taken hold the last few years. Fannie Mae and Freddie Mac will do build to rent. similar to an apartment building. So you're eligible for all of the same concepts that you would be under a traditional multifamily loan. A little bit of the challenges is they don't do phased lending on them. So you do have to bring a completed occupied development, which right now what we see a lot of the building structure is maybe there's an agreed upon plan to do, let's say 100 units, but they're being delivered like in segments of 10 to the end user. And that doesn't work for us. We can't finance them in buckets of 10. So you have to figure out a way to get them all the way to the end, all 100 of them, let's say, and then come to us for a permanent loan. With that being said, there are numerous savings banks who will step in and do it chunk by chunk by chunk. And I'd be happy to make intros for anybody who may be seeking out opportunities in that space currently.
So if you've got somebody, because I think we had some other questions that were similar around new construction financing. But if you've got somebody or somebody's got a project that's say 25, 50 units, whatever, it's fully completed. But what if it's like 75% occupied? The other units are built, ready, they're in process of leasing, but they're not quite all leased up yet, or maybe even they have some leases on them. Is that something you guys can finance, or does it truly need to be, 90% plus occupied?
We kind of have some thresholding, right? And so we would generally say like, hey, we're happy to start your loan at 70%. When do we think we're going to get to 90, right? And can we kind of time this out where, you get your 90%, your tenant moves in, you now have 9 out of 10 checks, let's just say for ease. And we go, okay, great. Here's your commitment. Let's close in a week, right? That's one option. We have lease up programs where we can try to close with a lower level of occupancy. But truly, you're going to pay a little bit of a higher rate. You're going to leave some money on the table, which in the current economics for a lot of people just doesn't work, right? Based on how much leveraging they may have on their construction loan. They might not want to take long-term perm debt until they can really max it out. And we'll work with folks as to when's an appropriate time to kind of start a loan so that we can try to line up a closing with reaching a level that will finance them to a dollar amount that works.
I appreciate that. That's good insight on the new build to rent kind of model we're seeing, having a lot of interest. People are, I've looked at buying new stuff. I know Logan's looked at buying and building new stuff. So that's an interesting newer model, or at least newer to me. Any other questions we have, Katie?
Yes, we do. Kenneth wanted to know if, as a lender, you're more concerned about the DSCR or LTV when figuring loan limits on multifamily. What are your assumptions on rent growth and expense growth when underwriting deals today?
Sure. The vast majority of our markets are going to be leveraged to a maximum 75% LTV, with some locations eligible for up to 80%. And on the DSCR side, the standard is a 1.25% with possibilities to go lower, but that's probably the anomaly, not the norm. We are a in-place cash flow underwriter. So while we are looking at projected income and projected rent down the road to make sure we're not going to run into a buzzsaw when our loan is ready to mature, we are truly taking today's numbers. So if you're buying a building and the rents are below market, we love that you have that upside potential, but we're not going to underwrite those rents that aren't in position yet. And for expenses, we generally will adjust to market appropriate unless there's a reason not to. Vis-a-vis, sometimes we'll see a purchase, right? And it's like, well, the payroll's through the roof, and it's because, the dad and the son have really kind of been paying themselves to run it for the last 15 years. We recognize that's not normal. We would look to see, what's an appropriate level of payroll for a building in that location of that size. And so it's a little bit of I'd say a science of trying to balance, what's there versus what does it cost in the marketplace. We definitely think overall that expenses are growing faster than income. I don't think that's going to shock anybody here. Again, taxes just keep going up and insurance just keeps going up. And from my knowledge, water and electricity and gas are not getting cheaper. So it is a tough time.
Eggs, you didn't mention eggs. How expensive eggs have gotten.
I'm sure somebody's probably offered Alex like 2 dozen eggs to acquire a building that he's selling, something like that.
Oh yeah. Yeah. Pretty easy sell there. Go ahead, Katie. Sorry.
I was just going to say we have 2 more questions, and then we can we can part ways. I know we're running over a little bit, but wanted to make sure everybody got their questions answered.
Yeah, thanks, Rob, for hanging out.
Sure, my pleasure.
Let's see, from Jason, we have what physical and economic vacancy rates are experienced conservative investors that are still closing on deals today, using NKC in their underwriting. Let's say 50 to 180 units, C vintage, BC area, for example, investors like FTW, Worcester, Yarco, etc. That was kind of I worded that. I kind of threw you on that one with so it's just what vacancy rates should an experienced conservative investor be looking at if they're looking at that 50 to 180 BC area.
I mean, we're still seeing, I think most, if you look, whether you use Restata or CoStar, right? Most of the local markets are still running sub 6%, if not sub 5, in terms of economic and physical vacancy. With that being said, we never underwrite less than 5. That's kind of our floor for residential income. We will use a 10% vacancy on any commercial. Really, this goes back to what I was saying before, though. It's what is happening, and it's not necessarily relative to how many tenants are occupying the units, is how many people are paying. We will see 2 buildings on the same street. One's got perfect collections for whatever reason, and the guy right across from him is only collecting 70% of his rent roll. It's a little bit of a mixed bag as to whether that's an operational function, if you just drew the unlucky straw and have a couple tenants who either can't or won't pay. But that's really where the focus is how many folks are paying, and if they're not paying, what can you do logistically to get them out and move someone in who will pay. We see a lot of people picking up buildings thinking that's an easy process. And then they find themselves, in long drawn out court battles trying to move someone out of their property who's not paying. And all that while it's not just lost income, it's an expense, right? They're using utilities, they're damaging your unit, and it's costing you even more.
I think we're down to our last question from Randy Kimmel. He just said, Rob, are you financing purchases or do you do new construction as well?
Greystone is a lender. We are 99% either purchases or refinances. We do have a product for construction through our FHA HUD platform. It is the best construction debt terms you'll ever see. The problem is it takes over a year to close the loan. It is very expensive. And from that regard, we won't even look at a construction project where the debt's under 20 million. It's not that we don't like smaller deals. It's that the fallout rate is incredibly high. And so for us to even get into bed with it, it needs to be a bigger deal. Generally, you're going to be better off at a local savings bank. Their money might be a little more expensive. The leveraging might be a little less. Maybe there's some recourse, but you'll be able to get shovel in the ground quickly, which is really kind of the biggest piece to the whole puzzle.
That's all the questions we have for you, Alex.
Awesome, guys. Well, Logan, anything else on your end before we wrap it up? Okay. I'm sure Logan's busy with all the things he's got going on over there.
He's out looking for BTR properties. That's all.
Yeah, I'm sure. But I mean, I appreciate everybody.
Sorry about that. Can you guys hear me okay?
Oh, yep. There we go, Logan. Yep, can hear right now.
Okay. Sorry about that. I think I had my microphones mixed up. No, just wanted to say thanks to Rob for being here today. Thanks for everybody for joining, and being here on the first meetup here, and make sure to check out the in-person events that we have coming up next week and then in April. And we'll send a recording out to everybody that joined here, and yeah, just appreciate everybody spending some time on this Friday afternoon. Not like you can get out really on the golf course right now anyways, unless you want to freeze your tail off. So thanks for being here. We do have, and this is one stat that I'll just kind of, plug here. While MMG and CBRE and Northmark and some of the bigger brokerages are down 77% quarter over quarter on transactions, the smaller $1 to $5 million transactions, sellers are starting to come around on some of the pricing on those. So if you're in the market or interested in speaking with anybody here on the call, just reach out to us and just kind of get a landscape of what's going on, because we do have a lot of opportunities, and like Alex mentioned earlier, closed 3 deals last week, another one this week. So stuff is starting to come around. Sellers are starting to, understand that the pricing needs to come back to a decent level. And so we can help you stay, with the pulse on the market here. So appreciate everybody being here. That's all I got to say.
Yeah, appreciate that, Logan. I mean, yeah, feel free to reach out to anybody here. This was a great learning experience for me. I look forward to our next one in person with some more handshakes and fist bumps and maybe a couple cold ones. And stay tuned for that. And for those who I don't get to see next week at the Royals game, I will be watching probably the replay of the Royals game when I return. So thanks again, everybody, and we will chat soon.